I think I need to begin on the subject of Uber because the company has priced its IPO, $75.5 billion valuation. It's a down round in the IPO. A lot of people say that's a big deal. You've taken many companies public. I want to know what you think.
The down round is less consequential. And once upon a time, when I was on the pricing committee of Facebook in 2012, that $38 a share IPO price for Facebook was a little bit of a down round as well. More relevant, and I remember the 6 months after extremely vividly as we traded down. But I think that what's fundamentally important in a number of the soon-to-be technology public companies is the quality of the senior team. Who are the next Tim Cooks? Are there teams like Mark Zuckerberg and Sheryl Sandberg, Satya Nadella? Who are the teams that will grow into that kind of executive leadership position? The technologies will change. The business models, in many cases, will evolve and change. But that's what I would be focusing on for the long term if people are investing in public offerings today, either in the U.S. or in China.
I'm going to ask a facetious question, might even be an obnoxious question. Why go public anymore? Private markets are so deep.
The private markets are deep. There is a badge of honor long-term worldwide to being a public company. Access to capital will not always be close to what it is now, or the cost of capital is zero in the private markets. That changes, and there are tremendous opportunities through acquisition down the road or in other ways to buy companies globally for stock and long-term build in that way. And so there are good
use stock
reasons.
As your currency, in other words.
Exactly. And that would be a primary reason over the long term for companies that are excellent and ready to go public to go public.
Might it be the only reason?
It might be the only reason.
Isn't that interesting? At the same time, Jim, we see a torrent of money fleeing public markets and entering private markets. I need only point to the example of Blackstone, a company on whose board you sit, limiting the amount of money raised for its latest private equity fund at $25 billion. It's effectively oversubscribed.
Yes.
Are investors too enamored of the return premium in private markets?
In general, yes. Specifically in the very best cases, however, I believe that something has changed in the world of private equity and hedge funds and the major technology and media companies. I have never witnessed where scale and excellence have grown as they have in many of these industries. So when I look at the Blackstone board or I look at the Blackstone management team, Steve Schwartzman, Tony James, John
Gray, sure.
They are superb. And so the returns have not been diminished as the business has scaled, whether it's real estate or private equity. If we look at the best technology companies, the scale, of course, has been awesome, both in the U.S. and in China, and the excellence at the senior levels continues to increase. And there's one other element which, to me, is fascinating. Increasingly, the best private equity and hedge funds compete for exactly the same talent at the top universities as the very best technology companies such as Apple, Facebook, Google, and others. It's machine learning, computer scientists that are today's most valuable commodity, if you will, much more so than an NFL quarterback or a Premier League future superstar.
I'm glad you brought up the idea or the notion or the importance, perhaps, of scale, because it was front and center in an op-ed in today's New York Times written by Facebook co-founder Chris Hughes. I know you've read it. I'm sure you've talked to many people about it today. He makes the case passionately that Facebook should be broken up, that it's too big, that Mark Zuckerberg has become too powerful. Your thoughts?
I politely disagree with Chris, and I remember working with Chris many years ago, and when he took his sabbatical, which turned into a more permanent sabbatical when he left to work for the Obama campaign from Facebook. I think the fact of the matter is there's the public outcry And as we know, in Silicon Valley and around the world, there is anger and distrust of the very largest of the technology companies. Absolutely. Does that mean they should be broken up? Should Amazon be broken up into pieces? Should Alphabet be broken up into pieces? I would first turn to what antitrust and law would suggest. But technology moves awfully quickly. And as we've seen time and time again, many of the leaders of today fall behind. And there's always a new set of competitors worldwide that will give, in certain segments, the best companies a run for their money.
The rebuttal to that, of course, Jim, is would the world be better off, would America be better off had the government not broken up Standard Oil? Would America be better off had the government not broken up AT&T? Most people would say no.
The questions, again, I would say are, when you look at Microsoft in the 90s, or we go back to AT&T, this is a little bit different because the consumer, in many cases, has benefited enormously from lower prices, free delivery. Amazon has absolutely revolutionized not only shopping, but AWS by itself would be one of the 20 most valuable technology businesses in the world. And those AWS software tools have enabled a whole new generation of entrepreneurs. And so when people are as good as Jeff Bezos or Mark Zuckerberg, Larry Page, et cetera, Tim Cook, the question of breaking these companies up into pieces is worrisome to me just because there are so many great global competitors. And that's where push comes to shove. I like to see American companies succeed in a very dramatic way.
Many of those global competitors are emerging in China, another area in which you have deep expertise, having invested there for 17 years and traveled there for 20. Jim, are you concerned about the potential fallout from the trade talks between the Trump administration and the Chinese government and what it may mean for investors like you and your clients?
It's changed the nature of the investing. A year ago, there was cross-border investing occurring on both sides, US-China, China-US. Today, what we're seeing is a freeze-up and a freezing of cross-border investing. I very much believe US-China, China-US long-term is a fundamentally important relationship for us as investors, for us as citizens. And I'm hopeful that over the long term, the right reforms are made so that intellectual property is protected much more in China. At the same time, we're investing very significantly in what would be the Chinese Southern Bay Area, and the level of entrepreneurship there in artificial intelligence and cancer, in other areas of artificial intelligence, rivals only Silicon Valley in terms of the pace of innovation. And there are areas where I would love, for instance, to see Chinese artificial intelligence and cancer summit companies work with the U.S., and maybe we'll find some common ground. I'm hopeful, but I'm an optimist long term on U.S.-China, China-U.S.
Couldn't be a venture capitalist without being an optimist.
I could not.
Tell me, many people know that you have been focusing much of your investing activity in AI. As you mentioned, you're also working in the life sciences area. The question comes up about AI all the time, Jim. Do you need to be concerned about the impact that AI may have on society? I'm not going to go into all the details of how it may play out. There are lots of narratives on that front. Or from an investment standpoint, do you really need to care so long as you're on the right side of the trade?
Oh, I need to care, and I really do care. And so in the last 3 months, I attended the opening of the MIT AI launch as well as the Stanford AI launch. And ethics, linguistics, philosophy has to be married in not only the academic institutions when it comes to AI, but also the companies. And so, for instance, I've invested in a couple companies which are trying to use artificial intelligence and cancer data and some of the best hospitals in the world to help doctors and patients make better informed decisions about treatment. So one day in our lifetime or our children's lifetime, we can eradicate most forms of cancer. The ethics around data. Who owns our data, our healthcare and cancer data? Is it the general practitioner? Is it the patient, as I believe should be the case? Is it a specialist at an academic center? These are all questions which the very best companies, which will be the most successful, are grappling with today.